What does it really mean when the world's biggest, slowest, most conservative investors start quietly buying gold? Picture a vault, not a trading desk. A committee, not a day trader. A policy memo, not a tweet. Central banks move on years, not minutes, and when they reach for metal, it's rarely about chasing price. It's about shoring up power. So here's the question worth asking. When the people who print money choose to own something they can't print, what are they telling us? Start with what central banks actually do. They hold reserves, insurance for bad weather. Most of that insurance lives in government bonds and foreign currency, usually US dollars and euros. Those assets are liquid, they earn interest, and they're the plumbing of global trade. Gold doesn't do any of that. It doesn't pay a coupon. It costs money to store, and it sits there. Which is exactly the point. Gold is the one reserve asset that isn't someone else's promise. No counterparty, no sanction switch, no default risk. If a central bank wants a slice of reserves that can't be frozen with a phone call, it buys metal. But that's the macro headline. The motives are more granular. For emerging markets, gold solves three problems at once. First, concentration risk. If most of your reserves are in a single foreign currency and that currency swings, or if relations with that issuer sour, you're exposed. A steady drip of gold purchases diversifies the pile. Second, credibility. If your domestic inflation has been high or your currency has a bruised reputation, adding gold signals discipline to markets and to voters. It's the monetary version of posting a security deposit. We're serious about stability. Third, geopolitical insurance. In a world where financial sanctions are routine, the non-seizable slice of reserves suddenly matters. That's why the official sector's buying pattern looks different from investors chasing a chart. Central banks don't buy the spike. They build the base. They accumulate quietly, quarter after quarter, in ton-sized bites that never trend on social media. The data arrives late, the disclosures are uneven, and some purchases only show up after the fact. But if you zoom out, the message is consistent. The official sector treats gold like strategic infrastructure, not a trade. It's tempting to reduce that to a single narrative, de-dollarization. But the signal is subtler. The dollar is still the world's main reserve asset and will be for a while because it sits at the crossroads of liquidity, law, and scale. What official buying really says is not the dollar is dead, but monetary power is multi-source. A central bank can love dollars for payments and treasuries for liquidity, and still want a meaningful chunk of reserves in an asset without political risk. Think of it as portfolio construction for nation-states, cash for today, bonds for income, gold for sovereignty. The timing also tells a story. Official buying tends to accelerate after lessons, after crises that weaponize payment rails, after currency shocks that torch balance sheets, after debt cycles that remind everyone that risk-free is a term of art, not physics. When those memories are fresh, metal allocation looks less like nostalgia and more like prudence. Does that mean gold only goes up when central banks buy? No. The official sector is the slow current in a river with many flows. Investment funds, futures traders, jewelry demand, and technology use still drive price action week to week. Central banks set the background tide by removing float, metal that would otherwise be available at a given price, and by signaling that the asset has a strategic bid underneath. In practice, that means official demand can turn drawdowns into bases and rallies into longer cycles. But it doesn't immunize gold from corrections or calm markets when everything else is on fire. It also doesn't mean every buyer has the same motive. Some accumulate for diversification and never talk about it. Some buy to match domestic savings preferences. When citizens trust gold more than banks, a central bank that holds gold is mirroring its society. Some use gold as a diplomatic tool, settling bilateral trade in ways that reduce currency exposure. And a few buy for a reason as old as finance. They think they can purchase optionality cheap today that will be priceless later. There's a mechanics angle most people miss. When official buying rises, it changes refinery behavior, bar formats, and trade routes. More bars destined for official vaults means fewer bars available to the retail and wholesale market. Premiums can widen in Asia. The private market feels tighter even if mine supply is steady. If you've ever wondered why a modest price move suddenly meets scarce product in Mumbai or Shanghai, check the official sector. When they absorb metal quietly, scarcity expresses itself loudly elsewhere. Now, a reality check. Central banks also sell. They rebalance when gold gets too large within reserves. They pledge bars into swaps and leases to manage liquidity. They change frameworks when leadership changes. And official buying isn't infallible. Some banks bought high in past cycles and wore the mark-to-market pain for years. The signal here is not follow blindly, but understand why the slow money is moving. If their motive is structural while your motive is tactical, don't confuse their horizon with yours. So what exactly does official gold signal right now? 3 things that matter for anyone trying to read the road ahead. First, a premium on autonomy. In a world that's more polarized and more digital, monetary power is easier to flip off and harder to replace. Gold is the analog fallback. It lives offline, clears without permission, and crosses borders as chemistry, not code. When central banks prize a bigger slice of that, they're saying the future feels less predictable than the past. Second, a hedge against policy error. After a decade of near-zero rates, then the fastest hiking cycle in 40 years, reserve managers are reminding themselves that even the best-run systems can overshoot. Gold is the asset you hold when you don't want to pick a winner among currencies or guess which country will tighten or loosen at the right second. It's the "I don't know and I don't have to" portion of a sovereign balance sheet. Third, a recognition that trust, not math, ultimately prices money. Bonds are contracts. Currency is law. Gold is belief. When the official sector raises its allocation to belief, it's reading the room. Not to abandon the system, but to balance it. To say, we'll use the rails we've built, but we'll also keep a key to the side door. If you want to translate that into something practical, stop treating each monthly purchase as a trading signal and start watching the direction of policy. Are central banks telling you they value sanction-resistant reserves? Are they responding to domestic distrust of paper assets? Are they trying to smooth a volatile currency with a steady, non-political anchor? Each motive maps to a different future. In one, gold is a diplomatic tool. In another, it's a domestic confidence tool. In a third, it's a seatbelt for a shakier ride. And remember the limits. Gold won't fix a bad fiscal path. It won't replace liquidity in a crisis day one. It won't grow an economy. It sits in the corner like a fire extinguisher, awkward, heavy, slightly in the way, until the day you're glad it's there. Central banks know that better than anyone because they write the fire codes. So, what are they signaling? That the era of single-source safety is over. That resilience now means redundancy, more types of assets, more ways to settle, more paths around choke points. That the clean, post-war hierarchy of money is messier in practice than it looks in textbooks. Gold isn't the hero of that story. It's the ballast, the weight you add when the seas get choppy. Imagine the vault again. A cart rolls in. Another ton clicks into the ledger. Outside, screens blink, headlines sprint, opinions multiply. Inside, nothing moves but the pen. That's how central banks talk when they don't want to shout. And the message, written slowly in metal, is simple. In a world of promises, keep something that isn't one.